Welcome to the deep dive. We're plunging into the, well, often exhilarating, but let's face it, sometimes intimidating world of stock markets.
It definitely can be. Lots of information flying around.
Exactly. And have you ever felt like some traders just have this uncanny ability, like a crystal ball, anticipating every little shift?
That feeling of how do they know that?
Right. What if there was a way, a rigorous, well-researched way to get that kind of powerful perspective, quickly, thoroughly, without feeling completely, swamped?
Well, often the answer is about learning to read the market itself, its own language.
Precisely.
Yeah.
So our deep dive today is all about technical analysis, or TA, as it's usually called.
Yep. TA.
It's a really popular approach, helps you form a solid view on a stock, maybe an index, and even helps you define the actual trade entry, exit, risk, the whole package.
Keeps things disciplined.
It does.
Yeah.
So we've gathered a whole stack of your sources on technical analysis, our mission, to pull out the most important, the most potent nuggets of knowledge, so you walk away genuinely well-informed about this whole approach.
We're going to unpack the core ideas, the tools you need, and build up to a practical checklist for spotting opportunities.
Okay, so let's start at the beginning. What is technical analysis, fundamentally?
So, at its heart, TA is a research technique. You're trying to identify trading opportunities, but you do it by studying the actions of everyone in the market.
Okay, everyone's actions. How do we see that?
Through charts, stock charts. These actions, buying and selling, they create patterns over time, and those patterns, well, they send messages.
So the analyst's job is to read those messages.
Exactly. Decipher the patterns, figure out the market sentiment, and then form a concrete point of view. Okay, based on this pattern, I think the price is likely to go up or down.
Like reading the market's pulse. Now, to really get this, our sources have this great analogy. Imagine you're on holiday, right? Foreign country, totally new food scene.
Okay, I'm with you. Hungry already.
You wander onto this bustling food street, maybe 100 vendors. You have no idea what's good. What do? You got like two main options.
All right. Option one.
Option one is like fundamental analysis. You could pick a vendor, ask about every single ingredient, understand the cooking style, maybe taste a little bit, super thorough. You'll know exactly what you're getting.
But the downside.
It's not scalable, right? With 100 vendors, you'd spend all day analyzing maybe 2 or 3. You might miss the best food on the whole street.
Okay, makes sense. So option two, that's the TA approach.
That's the one. You stand back, you just observe the crowds. Where's the longest line? Which stall has the most buzz, the most people gathered around?
So you're assuming the crowd knows best.
Your assumption is simple. That vendor must be making the best food. You're betting on their collective action, the crowd's preference.
It's scalable. You just spot the busiest place, but the crowd isn't always right, are they?
Exactly. The crowd isn't always right. But the key insight is this. TA is about watching the market's behavior, the price action, right now. Not necessarily digging into the why behind it all.
It's about the what, not the why. What is the price doing, and what does that tell us?
Okay, that clears things up. But before we dive deeper, we really need to set some expectations here. This isn't like a magic wand for instant riches, is it?
Absolutely not. TA is not a quick, easy way to make windfall gains. Thinking it's some kind of shortcut to easy money.
Yeah.
Well, the sources call that a recipe for trading catastrophe.
Oh, catastrophe.
Yeah. It takes real effort, discipline. You have to learn it properly. Now, if you do it right, sure, big gains are possible. But it's about consistent, informed decisions.
So where does TA really shine? What's its best use case?
It's generally best for identifying short-term trades. Trades lasting maybe a few minutes up to a few weeks, usually not much longer than that.
And long-term opportunities.
That's usually more the domain of fundamental analysis, digging into the company's health, its value, that sort of thing.
Got it. And the returns. We shouldn't expect huge jumps overnight.
No, don't expect that. The real trick with TA, often, is finding those frequent short-term opportunities. You aim for small but consistent profits. They add up over time, compounding.
Okay, small and steady wins the race, potentially. But what if a trade goes wrong? What if your TA signal doesn't pan out?
This is probably the most critical rule in trading, TA or otherwise. You have to cut your losses. Simple as that.
Don't just hang on hoping.
No. TA trades are short-term by nature. If it goes sour, get out, preserve your capital, move on to the next opportunity. It's all about managing that downside.
That's a really crucial point about risk management. Okay, let's talk about the actual building blocks, the charts themselves. One fascinating thing is just how versatile TA is.
It really is. Once you learn the principles, the tools, you can apply them to pretty much anything.
Anything, like stocks, commodities.
Stocks, commodities, currencies, bonds, doesn't matter. As long as you have historical price data, that time series data, TA tools can work.
It's like learning to drive a car, isn't it? Once you know how, you can basically drive any car.
That's a perfect analogy. Unlike fundamental analysis, where, say, analyzing a tech stock is totally different from analyzing oil prices.
Right, different metrics, different industries.
Exactly. But with TA, the way you use a candlestick pattern or an indicator like MACD, it's the same logic, whether you're looking at Apple stock or gold or the euro-dollar exchange rate.
That definitely simplifies things if you're interested in different markets.
Mm-hmm.
So, what are the bedrock beliefs TA stands on? The core assumptions?
There are basically four main pillars. First one, markets discount everything, meaning all known information, and even stuff that isn't public knowledge yet but someone knows. It's already reflected in the current stock price.
How does that work? Like insider info?
Yeah, think about it. If some insider knows good news is coming and starts buying shares quietly, that buying pressure itself will start to push the price up even slightly. A technical analyst might see that uptick, that unusual volume maybe, and think, something's going on here, without needing to know the specific news.
So it's less about why the price moved and more about what it did.
Precisely. That leads to the second assumption. The how is more important than why. A technical analyst focuses purely on the price reaction. How did the market react? They don't necessarily need to dig into the reason why that insider was buying. They just observe the effect on the price and volume.
That's a clear distinction. Assumption number 3.
Price moves and trend. This is absolutely fundamental to TA. Major market moves, big swings up or down, they don't happen randomly. They're usually the result of established trends.
So once a trend starts,
it tends to continue. Whether it's an uptrend, a downtrend, or even a sideways trend, the price is likely to keep going in that direction until something significant happens to change it.
Which brings us nicely to the fourth assumption. History tends to repeat itself.
Indeed. And in TA, this means price patterns and trends tend to recur because, well, human psychology doesn't change all that much.
Greed and fear,
hope, panic.
Yeah. Market participants tend to react to similar price movements in remarkably similar ways over time. When a market's soaring, greed often kicks in, fueling more buying. When it's crashing, panic drives selling. This consistency is why chart patterns often work. Okay, so we're looking at charts, but with millions of trades happening every day, we can't track every single tick. What's the essential summary we need?
You need the OHLC, open, high, low, and close.
Right. Open is the first price.
First price traded in that period, yeah. High is the absolute peak price reached. Low is the bottom tick.
And the close. My sources really stress the importance of the close price. Why is that?
The close is often seen as the most important because it's the final settlement price for that period. It's where the battle between the buyers and sellers ended for the day or the week or whatever time frame you're looking at.
So it reflects the final consensus.
Exactly. It encapsulates the market's collective decision at that point and serves as the key reference for the next trading period. Big institutional players often make decisions based on the close.
Okay, so we need to see all 4 OHLC points at once.
Yeah.
Regular line charts won't do that. What charting techniques actually let us see this richer picture?
Well, the simplest is the line chart, just plotting closing prices. Gives you a basic trend view, but it's thin information.
Not much detail.
Nope. Then you have bar charts. They show all 4 points. A vertical line for the high-low range, a little tick on the left for the open, and a tick on the right for the close.
Okay, better. More data.
More data, yes. You can see if it was an up day, close higher than open, or a down day, but honestly, they lack visual appeal, as one source put it, and spotting patterns quickly across many charts, it's tough.
Which is why most traders now use
Japanese candlesticks, they're pretty much the default standard now.
Right. They look intuitive. Tell us about where they came from.
Oh, the history's pretty cool. They go way back to 18th century Japan. A legendary rice merchant named Homa Munehisa supposedly used early versions to trade rice futures.
Wow, rice futures in the 1700s.
Yeah, but they didn't really hit the West until the 1980s. A guy named Steve Neeson discovered them and wrote about them. That's why a lot of the pattern names are still Japanese.
Fascinating. So how do they actually work? The anatomy of a candle.
Okay, instead of just lines and ticks, you get a rectangle called the real body. This connects the open and the close price.
And the color tells you.
Tells you the direction. If the close is higher than the open, it's a bullish candle, usually blue or green, sometimes white. If the close is lower than the open, it's bearish, usually red or black.
Got it. And those lines sticking out the top and bottom?
Those are the shadows, or wicks. The line above the real body, the upper shadow, goes up to the day's high price. The lower shadow goes down to the day's low price.
Ah, so you instantly see the relationship between all 4 points, open, high, low, close, and the direction of the move.
Exactly. It's much easier to interpret at a glance than a bar chart. A long body shouts conviction, strong, buying or selling. A short body suggests things were more subdued, maybe indecision.
Makes sense. Now, what about time frames? The sources say picking the right time frame is a crucial choice. Why?
Because the time frame determines what each candle represents. Is it 1 month of trading, 1 week, 1 day, or maybe just 30 minutes, 15 minutes, even 5 minutes for intraday charts?
And shorter time frames mean more candles, more data, potentially more noise.
Precisely. As you shorten the time frame, the number of candles explodes. You get a lot more detail, but also a lot more random fluctuation or noise. You need to pick a time frame that matches your trading style.
So, a long-term investor
Might use weekly or even monthly charts to smooth things out and see the big picture trend. They don't care about hourly blips.
but a day trader.
They'll likely focus on end-of-day EOD charts or maybe 15-minute, 5-minute charts to find opportunities that play out within a single day. High-frequency guys might even use 1-minute charts.
So the goal is filtering noise from relevant information based on how long you plan to hold a trade.
Exactly. Filter the noise, focus on the signal that matters for your strategy.
Okay, we've got the building blocks. Now for the really interesting part, actually deciphering these candlestick patterns. This is where we start reading the market story, right?
This is it. And it all comes back to that core assumption. History tends to repeat itself.
Because human psychology is consistent.
Right. If a certain sequence of buying and selling, represented by a pattern, led to a specific outcome in the past, we expect a similar outcome if we see that same pattern again under similar conditions.
Are there any specific assumptions just for interpreting candlesticks?
Yeah, a few key ones. First, buy strength and sell weakness. Generally, you want to be acting in the direction of the immediate momentum shown by the candle. Buy on a strong blue day, sell on a strong red day, if it's a pattern.
Okay. And second,
Be flexible with patterns, but quantify. Textbook patterns are rare. Minor variations are okay, but you need rules, like how much variation is acceptable. You need to define that. Don't just make excuses.
and the third one sounds really important. Look for a prior trend.
Absolutely critical. A bullish reversal pattern only makes sense if it appears after a downtrend. It's reversing something. Similarly, a bearish reversal pattern needs to come after an uptrend.
Context is everything. A pattern out of context is just random shapes.
Pretty much, just noise. The prior trend tells you what the pattern is potentially signaling a change from.
Okay, let's get in some specific patterns, starting with a powerful single candle. The marubozu means bald in Japanese, right?
That's right. Bald, or shaven head, referring to the lack of shadows, or wicks. And it's unique because it's the only pattern that basically ignores that prior trend rule we just talked about.
Why does he get to break the rule?
Because a marubozu screams extreme conviction, it's just a solid block of color, meaning the price opened at one end of the day's range and closed at the very opposite end.
So a bullish marubozu, open equals low, close equals high.
Pretty much, yeah. Maybe tiny, tiny shadows, but basically open, low, high, close. It shows buyers were in complete control all day long, extreme buying interest. The sentiment is overwhelmingly bullish.
I have the trade signal.
You'd look to buy near the closing price of that marubozu. Your stop loss would be the low of the candle itself.
Now, you mentioned a risk-taker versus risk-averse approach here.
Right. A risk taker might see the marubozu forming near the end of the day, confirm it looks valid, and buy right then, anticipating continuation. A risk-averse trader might wait until the next day. They want to see another blue candle as confirmation before jumping in, even if it means a slightly higher entry price.
Okay. And the bearish marubozu is the opposite. Open equals high, close equals low.
Exactly. Sellers dominated from open to close. Extreme selling pressure. Suggests the downtrend or start of one is likely to continue. You'd look to short near the close, with the high of the marubozu as your stop loss. Same risk profiles apply.
Now, the sources mention a trade trap associated with candle size.
Yeah, you generally want to avoid trading candles that are super tiny. They show indecision, low activity, not much conviction there.
And also avoid excessively long candles. That seems counterintuitive if they show conviction.
They do show conviction, but think about the stop loss. If you trade a massive Marubozu, your stop loss, the low or high of the candle, is now really far away from your entry point. The potential loss if the trade immediately reverses becomes painfully large. Your risk is too high.
Ah, okay. Risk management again. So beyond conviction, what about candles that signal the opposite indecision, like spinning tops and dojis?
These are classics for showing uncertainty. A spinning top has a small, real body. The open and close are close together and shadows on both sides that are roughly equal in length. The color doesn't really matter.
What does it represent?
It means there was a battle between buyers and sellers pushing the price up and down, but ultimately neither side could gain control. They ended up roughly where they started. Indecision, uncertainty.
And a doji.
Very similar, but even more extreme indecision. A doji has virtually no real body. The open and close prices are essentially identical or very, very close. It looks like a cross or a plus sign.
So if you see these patterns, especially after a strong trend, what's the takeaway for our listener?
Think of them as the calm before the storm. The existing trend is pausing. Something might be about to change, or the trend might just be catching its breath before continuing.
So you need to be ready for either outcome.
Exactly. Be prepared for a continuation or a reversal. It's a time for caution. Maybe minimize your position size, as the sources suggest, or perhaps book some profits on trades you already have open in that direction. Don't get complacent.
Because uncertainty can lead to sharp moves.
Especially if panic sets in. Indecision followed by a sudden shift can trigger really volatile moves.
Okay, let's look at a couple of specific reversal patterns. The paper umbrella family, hammer and hanging man.
Right. These look similar but mean different things based on where they appear. They both have a small real body near the top of the trading range and a very long lower shadow. The lower shadow should be at least twice the length of the real body. Very little or no upper shadow.
So the hammer, where does that show up?
The hammer is bullish. It appears at the bottom of a downtrend.
What's it telling us?
It shows that sellers initially pushed the price way down, creating that long lower shadow, but then strong buying pressure emerged, pushing the price all the way back up to close near the high for the day. It's like the market hammered out a bottom.
Signal to buy.
Yes, it's a potential reversal signal, buy signal. Stop loss goes below the low of the hammer, the bottom of that long shadow. A blue body is slightly more comforting, shows buyers won the closing battle, but a red hammer is still valid.
And the hanging man looks the same, but different context.
Exactly the same shape, but it's bearish. It appears at the top of an uptrend.
So same price action, rejection of lows, but after a rally, it means.
After a rally, seeing the price dip significantly low during the day, even if it recovers to close near the high, suggests selling pressure is starting to emerge. It hints that the bulls might be losing control. It looks like a person hanging, potentially ominous for the uptrend.
Signal to short.
Yes, it's a potential sell or short signal. Stop loss goes above the high of the hanging man. Personally, I find the hammer a bit more reliable than the hanging man, but both are worth watching.
Interesting personal insight. Okay, what about the shooting star? It's like an upside-down hammer.
Pretty much, yeah. An inverted paper umbrella. It's a bearish pattern appearing at the top as an uptrend.
Characteristics.
Small, real body at the bottom of the trading range, long upper shadow, at least twice the body length, and little or no lower shadow.
In the story it tells.
It shows buyers initially pushed the price way up, creating the long upper shadow, maybe on enthusiasm, but then strong selling pressure came in, pushing the price all the way back down to close near the low. It's like the rally got shot down.
Signal to short again.
Yes. Potential reversal signal, suggesting the uptrend might be over. Short signal. Stop loss goes above the high of the shooting star, the top of that long shadow. A red body here makes the signal a bit stronger.
Okay, that covers some key single candles. Let's move to patterns that take shape over multiple days. First up, engulfing patterns. Sound powerful.
They are. They're two-day patterns. The basic idea is that the candle on the second day, P2, is much larger and completely engulfs the real body of the candle from the first day, P1, and they're opposite colors.
Okay, so let's take the bullish engulfing. Where and how does that form?
Bullish engulfing appears at the bottom of a downtrend. Day 1, P1, is a red candle showing the downtrend continued. But day 2, P2, is a long blue candle whose body completely surrounds or engulfs the body of P1.
What's the significance of that engulfing blue candle?
It signals a potential reversal. It shows the bulls came in with sudden, overwhelming force, completely overpowering the previous day's selling pressure, a strong attempt to break the bearish trend.
Trade signal.
It's a signal to buy. Your stop loss would typically be placed just below the lowest low of the two candles, P1 and P2.
And for these multi-candle patterns, is the risk kicker approach, trading on P2 close, more common?
Often, yes. Because the pattern takes 2 days to form, waiting for a third-day confirmation might mean missing a chunk of the move. So risk takers often initiate near the close of P2.
Makes sense. And the bearish engulfing, top of an uptrend.
Exactly. Appears at the top of an uptrend. P1 is a blue candle showing the uptrend. P2 is a long red candle that completely engulfs P1's body.
Telling us.
The bears have suddenly seized control, overpowering the prior bullishness. Potential trend reversal downwards, signal to short. Stop loss goes just above the highest high of the two candles.
Now, you mentioned something interesting earlier, a catalytic doji appearing after an engulfing pattern. What was that about?
Yeah, this is something I've noticed in my own trading. If you get a strong engulfing pattern, say a bearish engulfing, and the very next day you see a doji.
The indecision candle.
Right. That doji appearing right after the strong bearish move seems to really unsettle the remaining bulls. It adds uncertainty to the panic already caused by the engulfing candle.
So conviction followed by indecision.
Yeah.
Bad mix for those on the wrong side.
It often seems to catalyze a bigger move downwards. As the source said, panic with uncertainty is the perfect recipe for a catastrophe. That doji can sometimes amplify the bearish signal, creating a potentially larger trading opportunity. It's like a confirmation of vulnerability.
Interesting nuance. Okay, slightly less dramatic patterns, the piercing pattern and dark cloud cover. Some of them do engulfing, but partial.
Exactly. They're like weaker cousins of the engulfing patterns. The piercing pattern is bullish, bottom of a downtrend. P1 is red. P2 is blue, but it only partially engulfs P1 specifically. It needs to close more than halfway up P1's red body, but not completely engulf it. So between 50% and 100% penetration.
Still bullish, but less conviction than a full engulfing.
Correct. And dark cloud cover is the bearish version, top of an uptrend. P1 is blue, P2 is red, opens above P1's high, but then closes down into P1's body, again, between 50% and 100% penetration. Signals potential topping, but less emphatic than bearish engulfing.
Got it. Now for harami patterns, which means pregnant in Japanese.
Yes, harami. It's a two-candle pattern. Think of it as the opposite of engulfing. Here, the first candle, P1, is long, and the second candle, P2, is small, and its entire range, body and shadows, is contained within the real body of P1. Like P1 is pregnant with P2.
And P2 is usually the opposite color.
Typically, yes. And that contrast signals a potential trend reversal because the strong momentum shown by P1 suddenly just stopped, halted by the small, contained candle P2.
Okay, so a bullish harami.
Appears at the bottom of a downtrend. P1 is a long red candle continuing the sell-off, but P2 is a small blue candle nestled entirely inside P1's body.
What does that small blue candle signify?
It's unexpected. The bears were dominating. Then suddenly this little pocket of buying appears, halting the decline. It unnerves the bears, as the source puts it. Their control is challenged. Signal to potentially buy. Stop loss below the low of P1.
And the bearish harami, top of an uptrend.
Right. P1 is a long blue candle, strong uptrend. P2 is a small red candle, completely contained within P1's body.
And that suggests
that unexpected negative drift, even if small, causes panic among the bulls. Their strong advance has suddenly stalled. Potential sell short signal. Stop loss above the high of P1.
Okay, moving on to 3-day patterns. Star formations. Before we get into the morning and evening stars, can you quickly explain gaps on a chart? We see them sometimes.
Sure. A gap happens usually between the close of one day and the open of the next, when the opening price is significantly different from the previous day's closing price, with no trades happening in between.
So a gap up
means buyers were so enthusiastic overnight, maybe due to news, that the stock opens much higher than where it closed yesterday. Bullish sign.
And a gap down.
Opposite. Sellers were dominant overnight, forcing the open price much lower than the previous close. Bearish sign. Gaps often show strong conviction.
Got it. So the morning star, bullish reversal, 3 days.
Yes, appears at the bottom of a downtrend and unfolds like this. Day 1, P1. A long red candle confirming the downtrend is still strong. Day 2, P2. The market gaps down from P1's close. Then it trades in a very small range, forming a doji or a spinning top. This shows deep indecision after the gap down. The bears couldn't push it much lower. Day 3, P3. This is the confirmation. The market gaps up from P2's close, and then a long blue candle forms, ideally closing well up into P1's red body, maybe even above P1's open.
Wow, quite a sequence. What's the story it tells?
It shows the bears were in control. P1 tried to push lower but faltered. P2 gap down plus indecision. And then the bulls came in with overwhelming force. P3 gap up plus strong blue candle, a clear transition.
Signal to buy.
Strong signal to buy, usually near the close of P3. Stop loss goes below the lowest low of the entire 3-day pattern, often the low of P2.
And the evening star is the bearish mirror image.
Exactly. Appears at the top of an uptrend. Day 1, P1, long blue candle, strong uptrend. Day 2, P2. Market gaps up, then forms a doji or spinning top. Indecision after the rally. Day 3, P3. Market gaps down, followed by a long red candle that closes well down into P1's blue body.
Same logic. Bulls lose control, indecision, then bears take over decisively.
Precisely. Strong signal to sell or short near the close of P3. Stop loss goes above the highest high of the pattern, often the high of P2.
Okay, so just to recap the entry exit strategies for all these candlestick patterns. Risk taker enters on the day the pattern completes. Risk averse waits one more day for confirmation.
That's the general idea. And like we said, for patterns spanning more days, like the stars, the risk-taker approach often makes more sense to capture the move earlier. But crucially, stop loss for longs is always the lowest low of the pattern. For shorts, it's the highest high. That's your safety net.
Absolutely. Non-negotiable. Okay, we've got the patterns down. But recognizing a pattern isn't enough, right? We need confirmation. Let's talk about support and resistance, S&R. How do these help?
S&R levels are huge. They are specific price points on a chart where, historically, buying or selling pressure has been strong enough to halt or reverse a price move. They help you identify potential entry points, but maybe even more importantly, price targets.
Okay, so define resistance first.
Resistance is a price level above the current market price where sellers are expected to show up in force. Think of it as a ceiling. As the price approaches resistance, selling pressure increases, potentially stopping the rise. It can act as a trigger to sell a long position or a target price if you are long.
And support, the floor.
Exactly. Support is a price level below the current market price where buyers are expected to emerge. As the price falls towards support, buying interest tends to increase, potentially halting the decline. It acts as a trigger to buy or a target price if you're short.
How do we actually find these levels on a chart? Is it an exact science?
Not an exact science, no. It's more art and observation. And they're better thought of as zones or areas rather than precise lines.
Okay, so how do you draw these zones?
First, load enough data, 3-6 months for short-term trading S&R, but maybe 12-18 months, even longer, for really significant levels. Then you scan the chart and look for at least 3 distinct points in time where the price clearly hesitated or reversed sharply at roughly the same level.
3 points minimum, well spaced out.
Yes. 3 is a good minimum, and they shouldn't be clustered together. Seeing the price react there multiple times, separated by weeks or months, gives you confidence in that level. Then you draw a horizontal line or zone connecting these points.
How reliable are these S&R zones once you've drawn them?
They aren't guarantees, of course. Nothing in trading is. But they represent high probability areas. You'll often see that well-established S&R levels are well-respected by the market. Why? Because traders remember these levels, algorithms are programmed with them, and again, history tends to repeat itself.
Okay. And how do S&R levels supercharge our candlestick patterns?
This is where things get really interesting. If you spot a bullish candlestick pattern, say a hammer, and the low of that hammer happens to fall right within a well-defined historical support zone, that's powerful.
Double confirmation.
Exactly. The pattern says buy, and the location says this is a likely place for buyers to step in anyway. It dramatically improves the odds. Similarly, if your stop loss for a pattern lines up perfectly with a strong S&R level, you have much more confidence in that stop placement.
That makes a lot of sense. Okay, another critical confirmation tool, volumes. You mentioned this tells us about smart money participation.
Volumes measure the number of shares traded during a specific period. If 100 shares are bought and 100 shares are sold, the volume is 100. It shows activity, participation.
But volume on its own doesn't tell you much, right?
Correct. Volume is useless in isolation. It has to be analyzed alongside the price movement and the prevailing trend. The key insight is that high volume often indicates smart money institutions, big players are active. Low volume usually suggests more retail, smaller trader participation.
And why do we care about smart money?
Because they move markets. Their participation gives validity to a price move. If a stock breaks out on huge volume, it suggests strong institutional backing. If it drifts up on low volume, maybe not so convincing.
Okay, there's a crucial volume trend table in our sources. Can you break that down? How volume confirms price moves?
Sure, this is really important. If price increases, A and D volume increases, that's bullish. Smart money is likely buying, confirming the uptrend or breakout.
Okay, good sign. What if price increases but volume decreases?
That's a caution signal. The price is going up, but fewer people are participating. It could be a bull trap. The move lacks conviction, might fizzle out, weak hands, pushing it.
Got it. Now the other way. Price decreases, A&D volume increases.
That's bearish. The price is falling, and lots of shares are changing hands. Smart money is likely selling or shorting, confirming the downtrend or breakdown.
And price decreases on decreasing volume.
Also caution, the price is drifting lower, but without much selling pressure. Could be a bear trap, weak hand selling, but maybe the big players aren't convinced yet. The decline might not last.
So when we see our candlestick pattern,
You must check the volume. Was the volume on the key days of the pattern above average, especially compared to, say, the last 10 days? If yes, fantastic confirmation. Avoid trades based on patterns that form on really low volume.
so let's say we have 1, a clear candlestick pattern, 2, the stop loss lines up with a strong S&R zone, A&D 3. We see high confirming volume.
That, my friend, is what we call a triple confirmation. That's a high probability setup. That's what you're hunting for.
Excellent framework building up here.
Yeah.
Okay, next tool, moving averages, MA, often called your trend following friend.
They really are. Moving averages basically smooth out the raw price data, making it easier to see the underlying trend by filtering out the day-to-day choppiness or noise.
And you mentioned the exponential moving average, EMA, is often preferred over the simple moving average, SMA.
Yes, generally, because the EMA gives more weight to the most recent price data. This makes it react more quickly to changes in trend compared to the SMA, which treats all data points in its look-back period equally. EMA is more nimble.
What's a simple way to use an EMA in a trading system?
A very basic approach is just to compare the current price to the EMA. If the price is consistently trading above, say, the 50-day EMA, it suggests the market is generally optimistic. Look for buy opportunities.
And below the EMA.
Suggests pessimism. Look for sell or short opportunities. You could even build a system. Buy when price crosses above the 50 EMA, selects it when it crosses back below.
How well does that work?
It works brilliantly in strongly trending markets. It keeps you in the trend. But in sideways, choppy markets, it generates a lot of whipsaws, false buy and sell signals as the price oscillates around the EMA.
So lots of small losses in choppy markets.
Can be, yes. The key, if you use such a system, is discipline. You have to take every signal, the good and the bad, because often one big winning trend trade will pay for all the small whipsaw losses. MAs are great for identifying longer-term ideas too, because they inherently keep you in the trend as long as the trend lasts.
Okay. And to combat those whipsaws, there's the MA crossover system.
Right, it's an improvisation. Instead of one MA, you use two, a faster one, shorter period, like 9 or 50 days, and a slower one, longer period, like 21 or 100 days.
And the signal comes from them crossing.
Exactly. A buy signal occurs when the faster MA crosses above the slower MA. This suggests short-term momentum is picking up relative to the longer-term trend.
Bullish.
And a sell signal. When the faster MA crosses below the slower MA, short-term momentum weakening. Bearish.
Does this give fewer signals?
Yes, definitely fewer signals than the price MA crossover. But the signals it does give tend to have a higher probability of being profitable, especially in identifying the start of more sustained moves. It filters out more noise. Popular combinations exist, like 921 EMA for short-term, maybe 5200 EMA for long-term investment trends. Helps you follow that old saying, the trend is your friend.
Great. Okay, moving on to indicators like RSI and MACD. The sources say these are supplementary tools, not the main event.
That's a crucial distinction. Think of them as adding another layer of evidence or perspective. They can function as standalone systems, but their best use in this context is to supplement the core analysis coming from candlesticks, SNR, and volumes.
And indicators can be leading or lagging.
Right. Leading indicators, like many oscillators, try to predict reversals before they happen. They can give early signals, but sometimes they're wrong. Lagging indicators, like moving averages, confirm a trend after it's already started. They're more reliable, but slower.
Okay, let's look at the Relative Strength Index, RSI. Popular one?
Very popular. It's a leading momentum oscillator ranging from 0 to 100. It measures the speed and change of price movements.
And the classic interpretation, overbought, oversold.
Yeah, classically. RSI below 30 is considered oversold, suggests the price has fallen too far, too fast, and might be due for a bounce. Potential buy area, RSI above 70 is overbought. Price might have risen too much, too quickly, due for a pullback, potential sell area.
But you hinted at a more advanced way to read it. What's the real insight?
The real insight comes when RSI gets into those extreme zones, below 30 or above 70, and stays there for a while.
So it doesn't immediately reverse.
Often, no. If RSI stays persistently above 70, it doesn't just mean sell immediately. It might actually indicate extremely strong bullish momentum. The trend is powerful. In such cases, the smarter play might be to trade with that strong trend, not against it. Use pullbacks as buying opportunities while RSI stays high. Same logic applies if it stays below 30 for a long time strong bearish momentum.
So context matters hugely.
Yeah.
What are the standard RSI settings?
Usually a 14-day look-back period with the 30 and 70 levels as the thresholds. But like most indicators, these are customizable. The defaults are a good starting point, though.
Okay. Now, the grand old daddy of indicators, MACD moving average convergence, divergence.
Yeah, it's been around a while. MACD is fundamentally a trend-following momentum indicator. It shows the relationship between two exponential moving averages of price.
How's it constructed?
It has two main lines. The MACD line itself is calculated by subtracting the 26-day EMA from the 12-day EMA. Then there's the signal line, which is simply a 9-day EMA of the MACD line.
Okay, bit technical. What does that actually tell us? What are the signals?
The relationship between those two lines shows changes in momentum. The primary signal is the crossover. When the MACD line crosses above the signal line, it's considered bullish. Upward momentum is accelerating. Potential buy signal. When the MACD line crosses below the signal line, it's bearish. Downward momentum is increasing, or upward momentum is fading. Potential sell signal.
Works well in trending markets, like MAs.
Yes, very much so. It helps you identify potential shifts in the prevailing trend's momentum.
And briefly, Bollinger Bands.
Bollinger Bands are great for visualizing volatility and identifying potential overbought, oversold levels relative to the recent trend.
How are they made?
You have three lines. The middle line is a simple moving average, usually 20 days, SMA. Then you have an upper band and a lower band, which are typically set at 2 standard deviations above and below the middle SMA line.
Standard deviations.
Yeah.
So they adjust based on volatility.
Exactly. When volatility is high, the bands widen. When volatility is low, they contract. It creates this dynamic envelope around the price.
And the trading signals.
The classic interpretation is mean reversion. When the price touches the upper band, it's considered potentially overbought look for sell signals, expecting price to revert back towards the middle SMA. When price touches the lower band, it's potentially oversold look for buy signals, expecting a bounce back towards the middle.
But you mentioned limitations earlier.
Yeah.
Especially in trends.
Yes, this is crucial. BBs work beautifully in sideways, range-bound markets. But in a strong, trending market, the price can walk the band. It can hug the upper band for a long time in an uptrend, or the lower band in a downtrend, without immediately reverting. Trying to fade the trend based solely on BB touches in these situations will lead to losses. The envelope expansion itself is a sign of trend strength.
Okay, so when we add these indicators, RSI, MCD, BB, to our checklist, there's a specific twist on how we use their confirmation, right? It's different from SNR or volume.
That's right. Candlesticks, SNR, and volumes are more like primary, almost mandatory checks. Indicators are secondary confirmation. Here's the twist. If your main setup, candle plus SNR plus volume, looks good, and DD the indicators, like MACD crossover or RSI level, also confirm the direction, great. This gives you added confidence, so you might scale the size higher, put on a larger position.
But if the indicators don't confirm, or even contradict,
then you don't necessarily scrap the trade if the primary signals are strong. Instead, you go ahead with the original plan based on the Campbell, SNR, and volume, but you scale down your bet size. You take the trade, but with less risk, acknowledging the lack of full confirmation.
that's a very practical, nuanced approach to using them. Okay, we've built up all the pieces. Now it's time to assemble the grand checklist, the framework for disciplined trading. But first, one more layer of confirmation, the Dow theory. Still relevant.
Absolutely. Charles Dow's observations from over a century ago still form the bedrock of much of technical analysis. Key ideas include markets discount everything. Trends exist. Primary, secondary, minor. Indices must confirm each other. Volume confirms the trend. Should rise with price in an uptrend, fall during pullbacks. And the closing price is paramount. Modern TA builds on these.
And Dow theory talks about the market moving in phases, like a cycle.
Yes, 3 main phases that repeat over time. 1. Accumulation phase. After a big sell-off, smart money, the institutions, start quietly buying shares at low prices when everyone else is pessimistic. This forms a base, a support level. It's often hard to spot while it's happening. 2. Markup phase, or public participation. Sentiment improves, the public and short-term traders start noticing the rising prices and jump in. This is often where the sharpest price gains occur. The trend becomes obvious. 3. Distribution phase. Prices are high, news is great, everyone's excited, the public is eager to buy. Now, the smart money that bought low during accumulation starts quietly selling their holdings to the enthusiastic public. This creates resistance, a ceiling.
And after distribution
Comes the markdown phase. Selling pressure overwhelms buying, prices start to fall, often catching the late buying public off guard. Pessimism returns, leading eventually back to
accumulation. The cycle starts again. And this takes years.
Typically, yes. The full cycle spans a few years for the broad market.
Right.
Understanding which phase the market might be in provides valuable context.
Dow theory also gives us specific chart patterns, right? Like double tops and bottoms.
Yes, classic reversal patterns. A double bottom is bullish. Price falls to a low, rallies, falls back to test that same low again, and then rallies decisively, breaking the previous rally's peak. Need some time between the lows, maybe weeks or months.
Signal the support held twice.
Exactly. Buyers defended that level twice. A double top is the bearish opposite price hits a high, pulls back, retests the high, fails, and breaks down below the previous pullback's low. Resistance held twice.
And these are stronger if confirmed by a candle pattern.
Oh, definitely. Imagine seeing a bearish shooting star form right at the second peak of a double top. That's a much stronger sell signal. Triple tops and triple bottoms are even more powerful, though rarer the level holds 3 times.
What about a trading range?
That's when a stock just bounces between a clear support level below and a clear resistance level above for an extended time. Sideways movement. Dow theory recognizes this as a valid market phase. It offers opportunities to buy near support and sell near resistance within the range.
Until it breaks out. The range breakout.
That's often a significant event. When price finally breaks out of that established range, either above resistance or below support, it usually signals the start of a new trend.
What makes a breakout true or reliable?
2 key things. High volume on the breakout day shows conviction, and strong momentum after the breakout. The price should move away decisively, not just poke out and fall back in.
Trading it.
Go long on a breakout above resistance, stop loss just below that resistance level. Go short on a breakdown below support, stop loss just above that support level. The potential target is often estimated as the width of the range projected from the breakout point.
And one more. The flag formation.
A classic continuation pattern. You get a sharp, strong rally, that's the pull. Then the price consolidates sideways or slightly downwards within 2 parallel trend lines, that's the flag.
What's happening during the flag part?
Usually it's profit-taking by shorter-term traders after the sharp rally, so volume might decrease in the flag. But the smart money that drove the initial rally, the pull, is still holding, expecting the trend to continue. When price breaks out of the top of the flag, it signals the uptrend is likely resuming, offers a second chance to get in.
Okay, almost there. Before the final checklist, the absolute gatekeeper. The reward-to-risk ratio, RRR.
Absolutely non-negotiable. RR measures if the potential profit of a trade justifies the potential loss. It's simple. Expected reward divided by risk taken.
How do you calculate risk and reward?
Risk is the distance from your entry price to your stop loss price. For a long trade, it's entry stop loss. For a short, it's stop loss entry. Reward is the distance from your entry to your target price. For a long, it's target entry. For a short, it's entry target.
That was a good RR.
You need a rich RR. For every $1 you risk, you should realistically expect to make at least $1.30 or more. Personally, my absolute minimum is 1.5.
So even if everything else looks perfect, great candle, S&R lines up, volume's there, if the RRR is, say, only 1.1 or less.
You pass. It's just not worth the risk. The potential gain doesn't adequately compensate you for the possibility of being wrong. This single calculation forces incredible discipline. It stops you from chasing trades with poor potential.
Okay, the moment has arrived. The grand checklist. Let's walk through applying it, step by step, maybe for a hypothetical long trade setup.
Sounds good. Let's say you're scanning charts after the market close. 1. Recognizable candlestick pattern. Okay, first you spot a clear bullish engulfing pattern at the bottom of a recent downtrend on stock XYZ's daily chart. That's your initial maybe.
Checkbox 1 potentially ticked.
2. SNR confirmation. Now, you look left on the chart. Does the low of that bullish engulfing pattern line up nicely with a previously established support zone? Yes, it does. And crucially, is that support level reasonably close to your potential entry, say within 3-4%? So your stop loss isn't miles away? Yes. Okay, strong S&R confirmation.
Double confirmation. Checkbox 2 ticked.
3, volumes confirmation. What was the volume like on the day the engulfing candle, P2, formed? Was it noticeably higher than the average volume over the last, say, 10 days? Yes, big spike in volume. Suggests institutions were buying.
It's triple confirmation. Getting serious now. Checkbox 3 ticked.
4, Dow theory perspective. Zoom out a bit. What's the bigger picture? Is the primary trend still down, but maybe this is forming a double bottom pattern where your engulfing candle is the second low? Or is it breaking out of a small trading range? Let's say you see it as forming a nice double bottom. That adds weight.
Dow perspective aligns. Checkbox 4 ticked.
5, indicators confirmation. The twist. Now check your MACD and RSI. Has the MACD line just crossed above its signal line? Yes. Is RSI moving up from oversold levels? Say it crossed above 30 but not yet overbought below 70? Yes. Okay, indicators confirm. What does this mean?
It means we can consider scaling our position size higher if we take the trade.
Exactly. If they hadn't confirmed, we might still take the trade based on the first 4 checks, but with a smaller size. So checkbox 5 ticked with scaling implication. 6, satisfactory RRR. Last but definitely not least, calculate it. Entry near the close of the engulfing candle. Stop loss just below the low of the pattern support zone. Target. Maybe the next clear resistance level higher up. Let's say this gives you an RRR of 2.2 to 1. Is that above your minimum threshold?
Yeah.
1.5?
Yes. Checkbox 6 ticked. Trade looks good to go, potentially with increased size due to indicator confirmation.
That's the process. Rigorous, systematic. It forces you to build a case for the trade based on multiple non-correlated factors. It stops you making those abrupt and reckless decisions.
That makes it so much clearer. It's a real framework.
Yeah.
Okay, for listeners wanting to put this into practice, what about charting software?
Yeah, you definitely need good charting software. There are paid options like Metastock, AmiBroker, TradingView, which often need separate data feeds. But honestly, for many people, especially if you're an active trader with certain brokers...
Like Zero.
Yeah, Zeroda's Pi platform, for example, is fantastic. It bundles the software and data, has great visuals, tons of built-in indicators and drawing tools. You can script strategies, trade directly from the chart, access loads of historical data. They even have tools like an expert advisor for pattern spotting and some AI features. And often it's free if you're an active client. Definitely worth checking out what your broker offers.
Good tip. And choosing the time frame again for someone starting out.
Remember the rule. The higher the time frame, the more reliable the signal. So for beginners or for swing trading, holding a few days, weeks, stick to daily, end of day or EOD charts. It filters out the intraday noise and gives clearer signals.
Avoid the temptation of 5-minute charts initially.
Definitely. Leave the super short time frames like 1-minute or 5-minute charts to the experienced scalpers who trade very differently. Daily is best for learning and swing trading.
How much history should be on the chart? Look back, period.
For general swing trading analysis, maybe 6 months to a year is fine. But when you're specifically drawing your key support and resistance levels, you need more context. Load up at least 2 years, maybe more, to see those really significant historical turning points.
Okay. Now, you can't scan thousands of stocks every day. How do you build your opportunity universe, your watch list?
You need a manageable list. Focus on stocks with good liquidity. Means high daily trading volume, maybe 500,000 shares, and a tight bid-ask spread so you can get in and out easily without moving the price too much.
And avoid certain types.
Yeah, probably avoid very low-priced penny stocks or stocks known to be heavily operator-driven or manipulated, as TA might not work as reliably there. If you want to day trade, make sure they're in the right market segment, like EQ segment in India.
Any recommendations for beginners?
Honestly, for beginners, just stick to the major index components, like the Nifty 50 stocks or the Sensex 30 or S&P 100 500 components, depending on your market. These are large, liquid, heavily researched companies, less prone to weird manipulation. It's a good starting point.
Makes sense. Okay, finally, let's operationalize this. The Scout, your daily routine for finding swing trades using this checklist. How does it work?
It's a 2-step process, usually done after the market closes each day.
Shortlisting, the quick scan. Go through your entire opportunity universe, say all 50 Nifty stocks.
Yeah.
Spend maybe 10-15 seconds per chart. You're just looking at the most recent candles, maybe the last 3 or 4, for any sign of a recognizable pattern forming. Don't analyze deeply yet. Just quickly shortlist maybe 4 or 5 stocks that look potentially interesting.
Okay, quick filter. Then part 2.
Part 2, detailed evaluation, the deep dive. Now, take those 4 to 5 shortlisted stocks and spend 15-20 minutes on each one, applying the grand checklist rigorously. 1, pattern and trend. Is the pattern clear? Does it fit the prior trend rule? 2, volume. Was volume confirming on the key days, above average? 3, S&R. Does the stop loss align with S&R? Is it within acceptable range? 4%. Does S&R also suggest a reasonable target? 4, Dow patterns. Any confirming Dow formations visible? Double tops, bottoms, flags, ranges. What's the broader market phase? 5, RRR. Calculated precisely. Is it at least 1.5 or your minimum? 6, indicators. Check MACD RSI. Do they confirm scale up size or not? Scale down size.
And after all that scrutiny, what's the likely result? Lots of trades.
Honestly, no. On many days, you might find only 1 or 2 trades that pass all the checks. Some days, you'll find none.
And that's okay?
That's more than okay, it's crucial. As the sources say, deciding not to trade in itself is a big trading decision. It means you have discipline, you're waiting for the high probability A+ setups, not just trading for the sake of it.
Patience and discipline. Got it.
Just a quick word on scalping for the very experienced, very different mindset.
Very different. Scalping is about high frequency, large position sizes, holding for minutes, sometimes seconds, aiming to capture tiny price movements repeatedly. Candlesticks and volume are critical. RR might be lower, maybe 0.50, 0.75 is acceptable. You cut losses instantly, often need to watch global cues simultaneously, need a super low-cost broker. It requires immense focus, quick reflexes, and a machine-like approach. Not for beginners.
Definitely sounds intense. Wow, okay, we have covered a ton of ground today, a true deep dive.
We really did. From the basic philosophy, the OHLC, the power of candlesticks,
To deciphering single and multi-candle patterns like Marbozu, hammers, engulfing stars.
then layering on the critical confirmations, support and resistance, volume analysis, moving averages,
And using indicators like RSI and band CD effectively with that important twist.
and finally, bringing it all together with Dow theory and the RRR into that comprehensive grand checklist. It really feels like we've built a solid thinking framework. This isn't about making random guesses. It's about having a structured, scientific approach to viewing the market. It ensures you're not making those loose and unscientific decisions.
Yeah, exactly. The real goal here isn't just memorizing patterns. It's about understanding that candlesticks, volume, S&R, they're all part of a language, a way of thinking about and interpreting collective market behavior.
So the final thought for you, our listener, as you start looking at charts now, how will you apply this framework? Can you start seeing the stories these patterns tell? Can you use this process to develop your own thesis on a stock?
Explore how these concepts actually play out in the live market. Observe. Practice.
The journey doesn't end here, of course. We'll continue exploring crucial topics like backtesting strategies, robust risk management techniques, and the huge role of trading psychology in future deep dives. Until then, happy charting.